When you're ready to stop playing the lottery and actually learn how to do this, come on over to Galaxy Trading for thousands of hours of educational content, weekly class sessions, live trading, and a kick-ass group of traders. The best part? Actual timestamps and receipts of our work. Once you see it, you can't unsee it, and you'll never go back to the way you're trading right now. See you soon. playing the lottery and actually learn how to do this, come on over to Galaxy Trading for thousands of hours of educational content, weekly class sessions, live trading, and a kick-ass group of traders. The best part? Actual timestamps and receipts of our work. Once you see it, you can't unsee it, and you'll never go back to the way you're trading right now. See you soon. First off, welcome. I have a feeling that you're going to either leave this session that we have and say to yourself, whoa, that makes a lot of sense. Like, a lot of that stuff is clicking, and you're going to start to become a little bit of a, an addict. You're going to start going through millions and millions of charts, which to me I think is a good thing. I think that level of practice is only going to expedite the process. Or you could be in the other part of this where you see it and you say, there's no way I'm ever going to get to this point. I'm done with this shit. I'm quitting, right? And I will say that it doesn't happen all that much, but if you do feel yourself kind of feeling a little overwhelmed, that is okay. With time, it's all going to come together. Tonight, we're just doing really basic brush strokes on some of the key concepts. I know I spoke to a few of you. You've already, watched some of the videos that I had made on them where they get much more in depth. To me, this is step one. This is really just entry level. Like, you're going to hear me say these words, at least kind of have somewhat of an idea as to what it is. There is a very regimented process here, and the beauty of it is each specific model that we're going to talk about, because realistically we have about 4. You don't need to use all of them. You don't need to use any of them for that matter. You might find something in what I'm showing you here that resonates well with you and something that you can build off of and create your own thing, right? You really don't have to use any of mine, right? I know a lot of people in here do use the Mando model and the London kill zone specifically. A few use the odd NAM, which is, we'll get to it, but just basically the inverse of our Mando model as it is. And then last but not least, it's kind of the ICT unicorn. So it all comes together there. You guys can all hear me now? Eva, you good? Let's see, I just saw those messages. Yeah, I just want to make sure you guys can all hear, and then we'll get into it. Let me just make sure he's good before we roll on here. But like I said, everything can really be segmented into, whichever one of these concepts that really click with you, and you can kind of create your own thing. And now the beauty of this is whenever you do ultimately create your own model, it's not some, pardon me, not your bullshit moving averages that are going to change all the time. It's not something that you can't go back in time and back test. This is something that you will be able to back test every aspect of said model in order to create something that, one, you can prove is prove success with, but in addition to that, it's something that you will have a lot of confidence in, and when you have confidence in something, odds are it's probably going to work out much better for you when you actually trust it, right? Because to me, there's 3 stages to this, and it's, first, you kind of have to have a basic understanding of the concepts. This, I don't think, is going to take all of that long. I think by the end of tonight, you guys will, and this is only really going to be an hour. It's nothing too crazy. But by the end of it, I just, a little bit of familiarity with it will definitely go a long way, because the next step really is to be able to start to see it. You start to see how price reacts to certain, whether it's an imbalance, whether it's an order block, whether it's a breaker. You see in certain market structures which imbalances would be more preferable in that situation. You look and see how price. When you're ready to stop playing the lottery and actually learn how to do this, come on over to Galaxy Trading for thousands of hours of educational content, weekly class sessions, live trading, and a kick-ass group of traders. The best part? Actual timestamps and receipts of our work. Once you see it, you can't unsee it, and you'll never go back to the way you're trading right now. See you soon. Reacts to liquidity. Once you start to see those things in hindsight, that's a very good sign, because ultimately you're not going to be able to anticipate price and see it before it happens if you can't do it in the past, right? So again, it's brick by brick. It's a stepping stone. You don't want to rush too much into this. Get the concepts down. I'm going to show you, and hopefully by the end of tonight, you're going to say, "Oh wow, I see how this works." Right? That's the goal. And if that works for you, slowly but surely, with more practice, it's all going to come together. We've had hundreds and hundreds of success stories throughout time in here. With we have over 100 past demo accounts for funded trading where you now are, you don't have to risk your own capital to trade anymore. 100 people have gotten that right to this point. How many have kept it? We'll find that out shortly. But that's in itself a stepping stone to prove to you that what you are doing is working. How can you be more efficient so that you don't lose that account, right? Or even if you're trading options, right? Same type of situation. How can you get your model to a point where you are consistently making money and not giving it back immediately, right? That's the goal. So, to build off of those three, first you got to kind of have an understanding, then you see it, and then you can anticipate it. Those are really the 3 steps. And overall, you're going to hear me talk about 3 main concepts that ultimately come together to create my trading model, the Mando model. Okay. The first being imbalances, second being liquidity, and third being market structure, right? All combined, that's where you get the Mando model, okay? So let's just go back in time a little bit and we'll take a look. And first off, I'll start with imbalances. This is very important because the imbalance itself creates really the entire makeup or trade plan associated with whatever we're looking at, right? Without the imbalance, for me, there's no entry. Right? Without the imbalance, I don't know where I should be placing my stop loss so that I do not get smacked if it goes against me, right? Really, without the imbalance, there's no trade for me, right? And there's certain situations and certain times throughout the day where you're going to notice, oh, okay, I can see it setting up. It's coming down to that imbalance. It's not quite there. I need to wait, right? So it's even giving you that I guess that little bit of a compass in terms of like, okay, I need to wait. There's nothing here for me, right? And to me, defining that prior to anything is very, very important. So we'll use this previous example on NASDAQ, as the basis for our idea here. But we'll draw our range. We'll get to that in a second. But the idea behind the imbalance is it is a specific region on the chart, okay, where you have an imbalance in price in one direction while there's an inefficiency in the other direction. What do I mean by direction? Whether it's up buy side or down sell side, okay? So when we see, and this is simply put what it looks like, and again, you'll probably be able to do this in 10 minutes, right? You were to look at a specific candle, okay, any of these candles, and what you notice is that on either side of this candle right here, there are no wicks on either side of this up close candle, right? From this point here to this point here, that is an imbalance. There is an imbalance in price in that specific region. Why? Right? So, to use terms that I don't really completely buy into these ideas, but there's an abundance of buyers and a lack of sellers in this specific region. There weren't even enough to get up into this specific region on the chart, and this ranges from 381 to 144. Okay, now the way that we look at this is inside this area, right? Think of a teeter-totter or a seesaw right at the park. You sit on one side of it, naturally the other side's up in the air, okay? Now every time price gets back into that imbalance, it's like throwing a sandbag on the other side. So over time, that area is going to be balanced. But one sandbag of 40 pounds and you're sitting on the other side 180 pounds, that's not balancing that range. So what we would anticipate is that when price hits that imbalance, right, we are going to hit it and take off. We don't really want to sit around in there too long. We want to get in and get out as soon as possible. Okay. So again, wick, body, wick. Okay. One more time. Wick, body, wick. Okay. Price gets into our imbalance. Price gets out of our imbalance. Okay. This is literally exactly what we want to see, right? We want to see price get in and price get out. Now, with that being said, that's a bullish imbalance. I'll show you what the bearish imbalance looks like very similarly. Here it is. So ready? Wick, body, wick. Okay, no wicks on either side. We would anticipate that when price gets into this imbalance, that price is going to get in and get out. Okay, here it is. Ever so slightly. Let's zoom in here and look at this. Price gets in, price gets out. Okay, that's exactly the most ideal situation we have there. Now the beauty of this is, obviously, with more time you'll buy into it, right? But I can tell you, and if you take my word for it, this works. Price gets in and price gets out. There's a few little things that we'll get into as to, what imbalance is more likely to be successful versus lower probability. We'll get to that in a second. But the beauty of these imbalances are that when you have one mapped out and there's one that's, specifically catching your eye, not only do you have your entry mapped out, right? Ideally, you want a long in a bullish imbalance, right? You want a short inside a bearish imbalance, okay? But prior to the trade, everything can be mapped out here for you. Here's what I mean by that. You have your entry at some point inside of this imbalance. You can even say to yourself, I want to see us leave the imbalance before I enter. That's fine. If you're anticipating price to go up from that point, what's the problem with letting it show you get out of it? That's fine. You might be a little late. You might lose out on a couple points, but that's okay ultimately, right? As long as price is going where it's going and your entry is not, let's say, for example, up in this vicinity, right? We'll get to that in a second when we map ranges. But also, you have your stop loss just in case you're wrong. The low of the candle that creates that imbalance is always my stop loss on trades. Why? If I'm using this imbalance as a way for me to structure an idea, ultimately, if that low of the candle, if that candle is taken out, what is that telling me? That price inside this region is now balanced. And my idea to buy the imbalance in price, it's no longer valid. If price is balanced, then why am I still hanging on to a trade that's, it's balanced at this point. The price range is balanced. Price can move freely within that zone now because that candle has been voided, right? So it gives me a very sweet criteria as to where entry, exit, and even my take profit. That's going to be when we fall into the liquidity part of things, which we will get to. But simply put, you can go into the idea and say, okay, I want to buy this imbalance. My entry somewhere in the 10,845 range with a stop loss down here at 10.76. If that's too big for you, like there could be a situation where you have a pretty big range and it might not be something that you want to really, potentially be wrong on, right? Let's say it's $10, right? If you're looking at something like SPY, or maybe it's a $10 candle. That's too big for me. You don't need to trade it, right? It's all mapped out there for you. If that's something that makes sense, fantastic. If you're trading futures, you know exactly how much money you could potentially lose in that situation. 20 points for each point times however many points. That's your potential loss. And then multiply it to where you think price is going to go times 20. There you go. You have your whole trade mapped out before you, right? So there's no more, oh shit, that loss was way bigger than I thought it was going to be. Right? There's none of that. You don't have to worry about that anymore because it is all mapped out for you well in advance. And if it's too big, if it's too big of a risk, you could potentially lose more money than you would have liked to lose, then you don't have to take the trade. Right? Go somewhere else. There's tons of names that you can look towards. Right? Now with options, it's not going to be as simple, right? Because options, you have to deal with a couple other things, such as delta, gamma, theta, you name it. There's Greeks associated with those specific contracts that do influence the amount of money that you can make or lose in a certain situation, right? And if you don't really know all of those that well, that's fine. Just drop something in the comments right now. I'll take a look and I'll explain that a little bit more. But options contracts are a little bit different than what it would be like trading underlying stocks or futures, right? Where it's just cut and dry. I buy at 10, I sell at 11, I make $1 per. It's not necessarily the case with an options contract. You're dealing with a lot of other external factors, which we call the Greeks. But even still, right? Your delta is the probability that ultimately that contract ends up in the money, right? And if that's the case, where you're looking to see, okay, well, my delta is 60. That means and you'll see it on any options contract you ever buy, it's going to show you the delta, the gamma, the vega, and your theta, right? Every single one, it's going to show it. What the delta is telling you is if you have a 60 delta, that means for every $1 move that you have, $1 up, you're going to gain $60 per contract. If it goes down $1, you're going to lose $60 per contract. So you can essentially do the math on, let's say, let's say it was a $4 loss and your delta is 60. 4 times 60 being 240. I know the max that I can lose in this is going to be $240. Plus you got to add in a little theta. We'll get to that later. But that's what you could potentially lose. So when I hear people, oh, I got in and it knifed on me and I got stuck in it, and that, to me, that's a lame excuse. You can have this whole thing mapped out prior. If it voids your plan, then why are you still trading it, right? You need to kind of become regimented in a way where you don't even think twice about it. If it takes out the low of the candle that created your imbalance, you were wrong. And if you can't become good at accepting being wrong, then this might not be the right business for you, because this is something where no matter what, you're going to be wrong. I don't care if you're the best trader in the world, you're going to lose, right? It's just a part of things. And honestly, the more and more that you look to press buttons, the higher the probability you're going to run into a couple losses are. But are you going to allow yourself to lose 10 winning trades of progress in one trade because you don't know how to pull the stop loss? You don't know how to take that loss. We've had it here, actually. We've had people who have gone on insane runs and they've totally blew it on a week of bad trades and not respecting a stop loss, right? Because you're all going to get to the point where you feel very confident that you can kind of identify where price is likely to go. It always comes down to that execution. And with time, your execution is only going to get better and better. But at first, you really have to start to embed it in your brain that this trade was mapped out prior. If I'm not following my plan, whose fault is this, right? A lot of it comes back to you, and a lot of people can't handle that. So that's why I'm just being very, candid about this and straightforward, because like I said, using these methods, you will have a trade mapped out for you. Are they always going to be correct? Probably not. More often than not, I think you'll be right, but probably not. And if that's the case, can you take losses? If you can't take losses, you're going to be in some trouble, because those losses that you don't take turn into massive losses when you don't know when to pull the trigger on something, right? So the risk management part of it, and you're going to hear me talk about this a lot over the next month, but I don't buy the trading psychology. I think it's important, but I think that it's secondary to actually having an understanding of how price works and how the market actually moves. If you don't have that, then of course you're not going to know, you're going to be sweating trades, right? Your psychology is going to be all fucked up because you don't have a specific game plan in play, right? You just haven't done it enough. Of course you're going to be sweating. You don't have confidence in it. You haven't built up that confidence in yourself to actually trust and respect the trade plan that you have mapped out for you, right? So that just all little secondary stuff that comes into play when this is just trading in general. But let's see. Yes. So the next concept, and also if you have any questions about imbalances at all, put them in the chat right now and we'll hammer it home. These are very important, just how to map them. Okay. And you're going to hear, I tend to use the universal term imbalances, but there are two forms of imbalances that kind of fit into that one folder for me. And the first being the fair value gap, which, when you're ready to stop playing the lottery and actually learn how to do this, come on over to Galaxy Trading for thousands of hours of educational content, weekly class sessions, live trading, and a kick-ass group of traders. The best part? Actual timestamps and receipts of our work. Once you see it, you can't unsee it, and you'll never go back to the way you're trading right now. See you soon. I showed you guys here, right, a fair value gap, right? We have a buy side imbalance and an inefficiency to the sell side. And up here we have a sell side imbalance, buy side inefficiency, right? Buyers are inefficient in this area, creating that imbalance in price, ultimately pushing price lower, okay? But the second form is something that I'm sure all of you who've been around for a little bit have seen or heard of before, and that's simply just a gap, right? If you have a gap higher, we call that a bullish volume imbalance, right? Gap lower, a bearish volume imbalance, right? Just gaps, but those gaps, they actually carry a lot more weight than what you might have thought. When you see a gap on the chart, a lot of the times they can kind of indicate the market's next move, right? If you're seeing a gap down up in premium of a range, we're going to get to the premium and discount, don't worry. But if you see one in premium, that's going to show you some urgency to move lower. If you see a gap up in discount of a range, oftentimes that's going to show you some urgency to get up and get going, right? Just all little things that you can add in as well. I just heard the Discord beep. I want to make sure. Okay, good. Yeah, no, I'm glad a lot of people who've been here for a while coming in just for a little refresher. But so that's first, imbalances. So nobody commented, so I'm guessing you guys got it. All right. Of course, if you have questions, feel free. But that'll be kind of step one. Now, step two, we'll go back up to liquidity, right? So this is arguably the most important concept that we're going to talk about. And this is ultimately, to me, where price movement stems from. And liquidity, just another word that you can use to associate with, would be money, right? Liquidity. The algorithm, which I hope that you all buy into by now, and if you're new here, I hope you will buy into it pretty shortly. But and again, not just from me saying it, but from seeing it for yourself, that this algorithm that delivers price is driven by money or liquidity, right? Now, ultimately, the whole idea here is for that algorithm to go chase liquidity. It's going to go to a liquidity target. And, you might be thinking, where the hell am I going to find that? To be honest, it's really not the most difficult thing, really. We're looking at key swing highs and swing lows, okay, as pools of liquidity, areas in which the market could likely go to, okay? Now, there's ultimately, and this is really the secret sauce behind trading, in my opinion, I think this is probably the biggest game changer for anybody, really. You can have a bozo using moving averages and trend lines, but if he has an understanding of the concept of liquidity, I think he'll probably do all right. But if we can get an idea as to where price is going based on our pools of liquidity, right, which you can, and I'll explain that next, that's market structure. But if you can get an idea of where price is going, that doesn't necessarily mean I need to buy this and hold it until we get up to buy side liquidity, right? Because there's a few red candles mixed in. You might want to take some profits. But if you're on the right side of this thing for the entirety of this range from discount to liquidity, buy side liquidity, which would be a swing high, sell side liquidity being a swing low, that's a lot of points that you're going to be on the right side of things for, right? This in itself is, 6,000 points. Do the math. 6,000 points times $20 per point. So that could be a lot of money. And again, you don't have to catch every single one of those points, but if you can catch a majority or a nice chunk of those, it's a pretty good feeling. That's a good amount of money that you can make, right? Now, how do we know which pool of liquidity the market is going to target? Is there a way for us to feel really good about it, right? And if you're here, you've probably seen me post stuff on Twitter, and when I post stuff on Twitter, the only way I'm posting on Twitter is if I feel really good about it happening, right? I don't want to be throwing out losers left and right, right? So, that component of it has actually helped me become better, because now if it's not clear as day or I feel like it's clear as day, I'm not going to post it, because I don't want to have a bunch of clunkers and for idiots to attack me all over the place, right? Unless it's really high quality, I'm not really gonna put it out there. But how do we identify which pool of liquidity we're likely to target? Well, we have something called market structure, or our trend, right? You've probably heard that word before. But how do we identify a trend, right? I'm not talking about using that line that people just do this and they try and use it to fit their narrative. That's the best, right? They just try and maneuver these like triangles all over the place to make it make sense when it's just a load of shit. There's nothing to it, really. But how do we know in a way that we can backtest and prove it that this is something that actually works? Okay. So ultimately, all that we're looking for, and I'm going to use, we can go back to, let's do it on the weekly actually. This way there's a little bit more humps and lows on a weekly time frame versus a monthly, which is really kind of pure and price movement is pretty smooth. But let's take a look, okay? So I think it's fair at this point to say that, let's go back here, whoops. We took out this high, right? And this goes for any high or low. We could do this anywhere. I know we're going back to 2018, but I just want to show you the repetition over the last couple years. It's fair to say that we took out this high with what price run? Okay. From our this low, swing low, to swing high. Fair? I think I would say that's a fair assessment, right? So we're looking for highs and lows to be taken out. If we take out a high, we are looking at a bullish trend. If we take out a swing low, we are looking at a bearish trend. And we're always going to be pivoting towards the higher time frame. The higher time frame, the stronger the setup is going to be, right? So if we have what would have been technically a bearish structure on a daily time frame, but our weekly, that's getting us down into discount, I'm going to pivot towards my higher time frame. My higher time frame is going to know all. We had this something similar to this happen a couple months ago, where we had a weekly imbalance, bearish imbalance form on Nasdaq. But then you look into the monthly time frame and you see that weekly imbalance literally just brought us into a monthly bullish imbalance, and we took flight from there, right? So I'm always deferring to what I see on a higher time frame. And how we analyze this and really come to conclusions is something that I think it's going to be beyond one night. I don't want to overload anybody, but at this point, my model, the Mando model, where it all comes together using the ideas of imbalances, liquidity, and market structure, is as follows. After we take out a swing high or swing low, I'm going to map the range that does so. Okay, so this is the price run that took out that high, correct? Okay. Now from this point, you're going to notice that price does not hit this 50%. What that tells me is our range is not set. Why? Our range won't set until we get an opportunity at equilibrium or fair value for whatever the asset is. Okay, if we do not get to that 50%, there's really no interest to me, because to me, fair value of a range or of whatever we're talking about, Nasdaq in this instance, is right in the middle of our high and our low. That is equilibrium, right down the pipe. Now, from this point, the way that I look at this specific range is anything above 50% is premium. I am overpaying for it above 50%. If it's below 50% in a bullish range, this is discounted, right? It is below fair value or equilibrium, right? So let's just pretend this is milk, and milk is $5, okay? $5, or generally $5. That's equilibrium. That's the midpoint value. Now, if you go to a place and you see, $7 for milk, you're probably, if it's a necessity and you need it, you might have to overpay for it, and that sucks because you could have went down the street and got it for $2 less, right? But if you see something that's discounted or on sale, you're probably more likely to buy that because it's discounted from its original value, its fair value. So if I don't get 50% on a retracement like so, all that tells me is that the range is not set. Okay? So from this point, you're going to look again, and you're going to notice that, again, we didn't get discount. Damn, man, I'm missing out on all this opportunity. Just wait. Here we go. Right up to the high prior to COVID. Okay? So you guys probably all know about the COVID crash, right? Quote unquote crash. That's what I call it. What is the COVID crash to me? Well, to me, this just looks like a discount retracement into, we have a couple, hold on, right here. There's one, and here's your second. This is what we would refer to as an inverse. Okay, ready? Discount retracement into a bullish imbalance. Hold on, where's this red one? Come on, give it to me. There it is. Prior to your run for highs. Okay. So, Mando, you were just talking to me about which pool of liquidity that we can target, why, what was that all about? When you have a bullish trend, when you've taken out a high, and you've seen 50% of a specific price range, go back and backtest this. Tell me how many times price gets into a discount bullish imbalance and takes off for buy side liquidity. Just go check in the Manda model folder. You guys are all in the group. There's a zillion examples. This is the market. This is how price action works. Look, just because it's what I use, don't take it out of context. Do it yourself, and you're gonna start to see, holy shit. Okay, got it. Now watch this. After you get your discount retracement into a bullish imbalance for your run to highs to complete my model, what is one thing that is noteworthy inside the entirety of this? And this is a broad question, so I'll give you the answer. If we're entering down here in discount, what's really our risk in this trade? Way less than 50% of our range to make way more than 50% of our range. If we're buying 79, right, it's lining up with 79%. We're not using Fibonacci. It's all just for measurement. But if we have an imbalance that down here, this is probably like 81, 82. We're scoring 82% of the range while only risking 18. Does that make sense to you? That makes sense to me. My reward is always way more than what my risk is going to be. And this is why this model, when I first got it put together and started to make sense of it, why it makes sense to me is because this is something that happens over and over and over again. And on top of that, if my reward is always going to outweigh my risk by a lot, that makes me feel pretty good, right? That makes me feel, okay, I can stop out 2 or 3 times. If I hit once, guess what? I erase those stop outs and still make money. That's the goal here, to really, and you might hear some people say, oh, the risk reward doesn't make sense if you know where price is going. Sure, but guess what? When people are just starting to learn how to do this, to have a better risk, have a better reward for your risk, to me makes a whole lot of sense, right? So, as we continue, we're almost done, I promise. Here's your low. Okay, what was the price run that took out our previous swing high pool of liquidity? Right here, and you see I have it labeled. What was that price run? Go through go to every single red candle or black candle. Ask yourself, do we see 50%? No. Okay, that's fine. Range is not set. Go to each red candle. Do we see 50%? Nope, we don't. What is that telling me? The range is not set. The range is not set. The range is not set. Aha! Got it. Low to our high. We now have an established range. This is something that I'll teach you guys after. I don't want to overload you, but when you see the first bearish imbalance happen, oftentimes that's telling you discount is coming. Okay? But from this point, you have a bullish trend. I think that's fair for everybody to say. We took out this high with that price run. Okay? We are now in discount of that bullish range. Okay? So with that, When you're ready to stop playing the lottery and actually learn how to do this, come on over to Galaxy Trading for thousands of hours of educational content, weekly class sessions, live trading, and a kick-ass group of traders. The best part? Actual timestamps and receipts of our work. Once you see it, you can't unsee it, and you'll never go back to the way you're trading right now. See you soon.
What can we look for? We can look for some sort of imbalance to be taking place in here. And I might just add that with where we currently sit on these NASDAQ contracts, they are adjusted over time, 3 or 4 times a year. Okay, so these levels might not be absolutely precise, but if you were to type in at Mando Trading within, I don't know, October 2022 in that tweet, you're going to see that we're going to have some sort of imbalance lining up. In this case, we have something called an order block, and this is for another time. But this is another form of an imbalance. It's for another time. Don't worry about this. You really don't even need to know about order blocks if you don't want to. But price gets down into this bullish imbalance down here in discount of your overarching bullish trend or bullish range. Okay. Now, from this point, which pool of liquidity is more likely to happen? You can just refer back to, is our trend bullish or is our trend bearish? If our trend is bullish, where are we looking? Upper highs. Remember that bear market of 2022? Yeah, I just call it a discount retracement into a bullish imbalance. That's all. All it is. Just took a little bit more time than COVID did, but guess what? Same result. Price just gravitates towards discount, specifically an imbalance, ultimately running for our buy side liquidity target, which is our previous swing high. That's all it is, folks. Ready? I got another one for you. Okay. So, following our first shift in structure here. Okay. You guys remember that bank crisis that we had with Silicon Valley and all of that nonsense, right? You guys remember that? Well, what happened after taking out this high? What's our range that we can map out from our low to our high? Fair? We took out this high with that price run. Okay. What do you notice here? What's in discount of this bullish range, right? When the bank started to blow up. No, we're just getting into discount bullish imbalance. Do you see why I don't give a shit about news? It doesn't matter to me whatsoever. Price is algorithmically delivered in a way in which it's something that is repeatable regardless of the news. I don't care. I'll go to any chart. I'll go to Tesla. I'll go to Apple. I'll go to Boeing from 1970. It doesn't matter. I don't have the earnings reports from back then. I don't know if they had wings flying, blowing off the planes back then too, right? I don't know any of that shit. But price delivers this way since the beginning of time. We can go back to Boeing if you guys want to do that. I have a whole video of that going back to Boeing. We did FedEx, or maybe it was UPS. I forget one of those. We're going back 40 years. These concepts still work. All right. Now here's your low to your high. Here's your discount bullish imbalance. So right when we hit 50%, what is the more likely draw on liquidity? You're going to hear us all talking about that in this group. Draw on liquidity. That is the target, basically. Where do we think price is likely to go? Well, we have a bullish trend. We got our discount retracement. We got into a bullish imbalance. Ultimately, we're looking for highs here, right? We're looking for a continuation. And there it is. Bingo. Run for highs, okay? Now the same thing applies. We took out this high with what price run? From your low to your high. No discount retracement. That's okay. What is that telling us? The range isn't set. Don't worry. We'll get an opportunity. I feel good about that, okay? From your low to your high. Here is your discount retracement. Do we have a bullish imbalance? Sure do. There's your run for highs, right? Once we get to 50% and this range is set, where is price likely to go to? Our buy side draw or our sell side draw? Are we bullish or are we bearish? Well, we're bullish. We took out this high here with that price run. We're looking for this high. Guess what? Low, up and through. Mando model is complete. Okay? Now, how about this one? What we're about to complete here, and I fully anticipate this happening over the next couple, hopefully sooner, but probably over the next couple of weeks. What was the price run that took out this high right here? From your low, your previous discount retracement into a bullish imbalance, to your, go to each red candle, you're going to notice that our range was not set. Even after here, our range wasn't set, right? 50% we need. That's okay. Discount retracement below 50%, check. Bullish imbalance, check. Let me remove this. It's a previous bearish imbalance. We'll get to that another time also. Price gets into discount, bullish imbalance. We sweep liquidity. Is this our range setter? Nope. Low to high. Here's your discount retracement. We sweep liquidity, gather money. This is something called turtle soup. Again, for another time, I don't want to throw too much at you, but this is a layup. Run for highs. That's the expectation. And that's going to complete the Mando model yet again. And that's it. That is the Mando model. Imbalances, identifying liquidity, understanding current market structure. That's really it. That's my model right there in a nutshell. Now, oh, you're just showing me NASDAQ. What do you want to look at? We'll look at anything. You want to look at Apple? Sure, we can look at Apple. Do you want to look at Tesla? Go ahead. Let's go. Go through 100 names. Don't matter. Ready? We'll see an immediate one right here. Low to your high. Discount retracement, 50%. Bullish imbalance, right here. Run for, oh, not yet. It's coming. Ready? Here's another one. Low to your high. We took out this high right here with that price run. We didn't get discount. That's fine. Did we get it over here? Not quite. Okay. Big range. Wait, one more time. Whoops. There it is. Okay. There she blows. There she goes. Next. What's the next one you guys want to look at? We'll look at Microsoft. We'll go through all of them. Don't matter. Ready? Same situation here. From your low to your high. Here's your discount retracement into a bullish imbalance. There's your run for highs. Mando model complete. Why are we targeting this high? Our trend is bullish. We got into a discount bullish imbalance. Buy side, here we come. Okay, next up. Low to your, whoops. Go through each red candle. Let's see if we get discounted. Nope. Okay, that's fine. Let's see. Did we hit it there? No. Nope. 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 No discount retracements. That's okay. We can look towards our daily range. That's what I currently have mapped. Right? If we go to the daily, it's going to be much more clear. Ready? So if you're not in discount on a monthly time frame, that's okay. You can look at something like Meta. That takes 11 years to complete a discount retracement on a monthly time frame. But go over to your daily time frame. Clear as day. From your low, whoops, to your high. Here's your discount retracement. Here's your bullish imbalance. Here's your turtle soup. That's just an added layer. You don't need it, but there it is. So far, so good. Where's our buy side target for Microsoft? 468.35. Right? Let's go to Netflix. Okay. Where are we? Go through each one of these little price fluctuations. Okay. And you can go through every time we've taken out a high. What happens? Okay. We took out this high with what price run? Low to high. Bullish imbalance. Run for highs. Mando model complete. We took out this high right here with what price run? Low to high. Discount retracement. Bullish imbalance. Run for highs. Mando model complete. Low to your high. Discount retracement. Bullish imbalance. That's a gap up. Volume imbalance, right? We talked about that. Run for highs. Mando model complete. Low to your high. Discount retracement. Bullish imbalance. Run for highs. What's next? Go on forever. Low. This is what we're currently working with on our range on the weekly. Any more? We can go through any. Does it work on crypto? Sure. Low, high, discount retracement, bullish imbalance, run for highs. Low, high. high, discount retracement, bullish imbalance, run for highs. Low, high, whoops, discount retracement, bullish imbalance, run for highs. You starting to see it? Come on, tell me you're starting to see it. Nice, great. Integrity. I knew you were newer here, so I want to make sure of that. What do you think, guys? What do you think? And what do you think, Ibra? What do you think, Flow Hunter? What do you think, Greg? And the rest of you guys have been here. Joe, what about you? What are you guys thinking? Repeatable. You sure you want to see it on GME? I don't want to show it, but I will. Fuck. What do you see? What was the price run to take out all of these all-time highs previously? Low to your high. Look what we got on GME right now, folks. One big Mando model. Deep discount, bullish imbalance. Low, high, discount retracement. It's a matter of time, unfortunately. That's all it is. That's a great question. Let me read out the rest of the comments, and Gash, I'll get to yours. That's a great question. See, it seems like an easy way to trade. Yep, the way, ultimately, it's something that maps out the entirety of your trade. Therefore, if you are wrong, you're stopping out for minimal losses. If it's not going to be a minimal loss, then why are you taking the trade? It's too big for you. You know that before you even enter the trade. Why would you take it if you think it's too big for you, right? That's the beauty of it. You have an idea of where the target is. It's going to completely outweigh the potential loss that you're going to take. And if it doesn't, then why are you taking the trade? It's mapped out before. You know what it could possibly be before the trade. There's no getting caught with your pants down in this. It's always mapped out. Beautiful with this simplicity. No favorite indicators, no mess of a chart. Starting to better understand the price delivery helps you really establish a plan. Yep, absolutely. You don't need any indicators. Anybody who tells you that you do, they're full of shit. It's to me, that is much more distracting than anything else. The news, what you see on CNBC, what you see from 99% of these idiots on Twitter, it's all bullshit. You don't need any of it. If you learn how to read price and you can see that this is something that is extremely repeatable, and remember, we have 4 of these. This is just one. This is something that you can feast off of, and that's all it takes. One setup. You don't need to trade the same exact thing. You don't need to, stress yourself out. If it's not there, you're going to finally believe that, okay, I don't need to trade because I know the next time I get it, I'm going to hammer it and I'm going to set myself up for a couple weeks, right? Yep, new indicators are time and price. That's it. The time aspect of it is something that is very important that we will get to at some point. But again, I don't want to overload anybody right now. This is great. This is a great question. Once the model is complete, do you go to the next swing low to swing high? Absolutely. Okay, and this is, Gaj, where the inverse Mando model, and we've kind of dubbed it the odd nam, comes into play. Okay, so let me see if I could cherry pick an example here. Let's see. We haven't had many of them because we've been bullish for so long. Actually, let's just go back to NASDAQ. We'll go back to the quote-unquote bear market. Okay. So at what point do we really know when this range is done? Did we reach all buy side or liquidity swing high targets? Yeah, if we did, then guess what? Anything above all-time highs, I got nothing for you. We've never been up there. There's no money resting up there for the algorithm to go and get. I have no idea when big money is going to start to sell off, right? That's as candid and to me as simple as I can possibly put it. I have no idea when this thing is going to stop on NASDAQ. Could we go to 25? Sure. Where are you getting that number? I don't know. I'm guessing. That's literally what it is. Anybody telling you that we're going to 600 SPY is just, yeah, I think that's where it's going. I think. There's no fabric behind that. We've never been there. There's no reason for the algorithm to drive to that point. We can use that as a specific target. Yet, we don't know when big money is going to pull their money off the table. When they tell us it's time, it's time. Okay? And how do we know it's time for us to go see discount?
When you're ready to stop playing the lottery and actually learn how to do this, come on over to Galaxy Trading for thousands of hours of educational content, weekly class sessions, live trading, and a kick-ass group of traders. The best part? Actual timestamps and receipts of our work. Once you see it, you can't unsee it, and you'll never go back to the way you're trading right now. See you soon.
Balance. Every single time that we've gone and seen discount in any of these price runs, back test it yourself, go look on any chart you want. Anytime we're about to go down to discount of the range, what do we see? Bearish imbalance. Okay. What do we see? Before we got down into discount right here. Okay, we got down into discount in August. Bearish imbalance. Every time. Every time we see discount, there's going to be a bearish imbalance. Bearish imbalance. Bearish imbalance. Look how price reacts to it. There it is. There was a few here, but our range was so quote unquote extended at this time. From 2020 to 2021, end of 21. And we ranged that range from 8,000 to 18. That's 10,000 points before you got any sign of retracement. Bearish imbalance kind of sold it to you, right? But that is essentially the odd name. When you see that bearish imbalance, you could look to play a retracement back into it and then ultimately look for a discount. Not as big of a risk reward type win as what you can get with the Mando model, but still, so you're not sitting on your hands waiting for price to retrace down here, because this took a while. This bear market, quote unquote bear market, November down to, it was about a year of us steadily declining prior to getting to a discount, right? Do you want to just sit here and wait a year before pressing another trade? Probably not. But it's just another thing that you can add to your toolbox as a way to identify a downside trade. That's the odd NAM model. That's another thing that we're going to get to in much more detail as we continue on here over the next couple months. If you look at our third, again, I'm just going to briefly go over these. Our London kill zone model, that's much more futures or index based. It's not so much the individual names, but it's something that you can use to look for a quick hit in the morning, right? It doesn't even have to be the morning, but it's a quick hit based on the London range that you're seeing in your futures data. That's another one that we can use. And the last being that unicorn model, which that one's going to be a little bit more confusing right now, so I'm not going to explain it because I didn't teach you guys anything about breakers yet, but that's coming. And those are the most powerful, in my opinion, the most powerful type of imbalance that we can really look towards. They don't always occur, but when they do, they bang. So let me come back over here and make sure. Everything else will mess you up once you learn time and price. It's true. And I always say this, just to be fair, just because you're here doesn't mean that you have to trade like any of us. You don't have to do that, But if I can show you one thing that you can add into an existing model that separates you, that's fantastic. That's a win. But you'll notice that all of those people who come in here with their own model that trade off of whatever it is, moving averages, trend lines, whatever, when they, been here for a little bit, you'll notice that slowly but surely each one of those indicators start to fall off until your chart's looking like this with nothing. The two I have are time-based. New week open gap, something we'll get to. And then just it maps specific times on the chart that when I click that on, it'll show me the 9:30 open. Again, that's the time aspect of it. We will get to that. But in terms of overall price delivery, can't get much more simple than this. This is something that is repeatable. It's something you can go back on any chart and do this on. Just got to give it a little bit of time, a little bit of practice. And the more time and practice you put in, all that's going to do is expedite the process for you to feel good about doing this for yourself. And when you do, start to reap the benefits. LKZ, yeah. Let's see. Mostly we all trade differently off the same concepts. Yep, basically, right. And that's the beauty of it, because there's a lot of things that fall under this umbrella of like reading price, right? There's totally a lot of stuff. But at the end of the day, like I said I led the whole thing off with this. You don't have to trade like me. You don't have to trade like KD. You don't have to trade like Sean. You don't have to trade like Ryan. You don't have to trade like Seeker. Go down the list. Cajun, Kyle, breaker model, right? Snaz. You all have different models, right? Now with that, what's the key takeaway to all of this? There might be one thing that sticks out to you. You might have heard me just talk about premium versus discount. That might be all you need. When we get into breakers, that's a big one because a lot of people have literally just built their model off of breakers. I know Kyle trades off breakers quite a bit. That's I don't know if it's exclusively his thing. Yeah, no, Ibra, you're right. We all trade ICT, but there's just so many different ways to go about it. And really, for me, it took me a while to settle in, use one, which is my Mando model, right? But beyond that, I started to say, okay, well, I see that price loves to come to discount. There's got to be a way for me to identify this and capitalize on that discount retracement so I can play it both ways. And then I, through back testing, this one didn't take as long because it's something as simple as an imbalance showing you that price wants to go to discount. Then that's where the odd NAM or the inverse model came from. The kill zone is a time aspect, and that one's really smooth too. Take out a higher low of that London kill zone, look for the opposite side following an imbalance formation. Smooth, nothing too crazy. And then the unicorn needs to know what the breakers are, which we'll get to. That's just a patented setup. It's visual, but we will get to that. I don't want to throw it all at you at once, but you won't be a poor. You go 2 weeks of working normal times, and you go 2 weeks off where you're working overnight and stuff, and then you try to trade the overnight, and it's not always great. But anyways, that is all I have. So for anybody in here who has any questions based on anything that we talked about tonight, feel free to send it over. I'll happy to answer any of your questions. And to me, I take pride in being able to answer the questions that are asked. When you ask somebody a question and they don't know what the hell they're talking about, they don't even address the question. I'll always address your question because I feel like with my model, I know all the ins and outs. Everything that you could possibly ask me about it, I feel confident to give you an example and an explanation as to why something would work, why something would not work. All right. So this is a lot of hours at work. What I just showed you there, I wish it was an hour long when I was putting it together, but that takes a lot of time. Snaz, I have it recorded. Don't worry. I'll put it on YouTube and I'll send it. But that's all I got. So again, if you have any questions about anything here, if you're struggling, if you're 3 weeks in and you're like, shoot, man, I got to figure this out. I'm falling behind a little bit. Just shoot me a message. We'll get it sorted out. Don't stress it. And don't be so eager to push buttons. If it takes you a little bit of time before you feel good about it, that's probably going to save you some stop out money along the way. Just take your time, learn the concepts, and when you learn the concepts, you're going to see how trading becomes fun. But that's all I got. So yeah, they're coming. Our lives like these are coming back October 1. So I just want to get some of the newer people here to get in the mix a little bit, just have somewhat of an idea, just so when we do start rolling, they're not completely behind. So, but all right, I'll catch everybody later on. See you.
stop playing the lottery and actually learn how to do this, come on over to Galaxy Trading for thousands of hours of educational content, weekly class sessions, live trading, and a kick-ass group of traders. The best part? Actual timestamps and receipts of our work. Once you see it, you can't unsee it, and you'll never go back to the way you're trading right now. See you soon. What's going on, everybody, and welcome to Galaxy Trading, lesson number 1 on the introduction to reading price action. There's going to be about 9 concepts that we're going to talk about over the next couple of weeks. I figured I would just make these videos in order for us to kind of speed up the process, especially on entry, so that when we do our live calls, you'll have a much better idea of everything that's going on. So in this video specifically, we are going to talk about the concept of imbalances, how to find them, what they are, and how we can use them to be successful in our trading ventures. All right, so what is an imbalance? In short, an imbalance is a lopsided price movement. Okay, so what I mean by a lopsided price movement is that inside a specific range, price was leaning, whether it was towards the buyers or sellers, in such a lopsided fashion that it's creating an imbalance in price. When you have an imbalance in price, our expectation is when price retraces lower back down into that imbalance, we're expecting, whether it's a bullish imbalance, for price to get into it and take off to the upside, and vice versa. If it's a gap down, when price moves higher into that imbalance, we would expect a rejection for lower prices, right? So that's basically, in short, it's a specific region or range on the chart that I'm going to show you how to identify, that when price gets into it, we are expecting a move to occur there, right? And if you've watched any of the videos I made on YouTube, I always say every price move is justified, right? And I firmly believe that every move, if we look left and we have information to our left, we can justify every single price move that occurs on the chart, right? But this is just the glaring one, and obviously because I'm making this video like this, I'm cherry picking it. But again, you throw in or ask me about any chart and we can go through it, and you'll see that every move can be justified. But here in this specific situation, right, you'll notice price bounces here, okay? So if we were to look left and we look in this specific region, we'll notice that this is our first type of imbalance that we look for. There's 2 of them, okay? So the first form of imbalance that we're going to look at today is called a fair value gap, right? So what that's insinuating is, and you see where I put this rectangle, I'm going to remove it just for 1 second, but you'll notice that on either side of this candle, there is no wicks on either side of that candle, right? So if there are no wicks within this specific range on the chart right here, right, that price is lopsided or imbalanced, right? So I use this example. Imagine you're sitting on a seesaw and you're on one side of it and nothing's on the other side, right? Naturally, you're going to the ground and the other side's going to be up in the air, right? So in this situation, the buyers who were taking total control of this region, right? No wicks, so it means price was not contested within this range. So again, that's us, and for every time price were to retrace back down into said imbalance, right? That's like you throwing a sandbag on the other side, right? Might not be enough just on one sandbag, right? Let's say it's one tap, right? One tap might not be all that's necessary to balance that price range out and for price to move freely again. So obviously here in this situation, you'll notice price retraces back down into it, perfectly fills it up, and takes off again, okay? So again, this can happen on either side of the chart, but this would be our first form, and this would be a fair value gap. So again, let's just see if I can identify any more fair value gaps that occur in this chart. Do they all need to get filled in? No, not necessarily. You're going to notice that there are probably a lot of unfilled fair value gaps below. So let's just take a look and see. Okay, so I see one right off the bat. Ready? From this high wick here to this wick right here, you'll notice on either side of that candle, there is no wick or no contesting of price in this specific range, okay? Let's continue. You'll notice, okay, we have another one here, very small, but still plays. Ready? From this candle's high to that candle's low right there, look.
You see, there's no wicks on either side. So to me, that is just an imbalance in price to the upside, right? A buy side imbalance, and there's an inefficiency to the sell side on these specific gaps right here, okay? Let's look here. Nope. So we have our body here and we have a wick here. So this candle is not imbalanced at all. Okay, this candle here, you have your wick here, you have your wick here. No imbalance here. Now let's take a look at this one right here. Ready? So here's your first wick. Okay, wick. Up to that wick, right? No wicks on either side of this 3 candle run, right? You'll notice price gets into it and takes off, right? Okay, so how do you control yourself over the gaps, right? Well, oftentimes that trade, those wicks are going to give you the heart attack, but the bodies of the candle are telling you the story, right? So how do we know when it's a good time for potentially an all-out stop, right? I use the candle that creates the imbalance, the low of that candle. So this candle here created the imbalance, right? So my stop out is going to be the low of that candle, okay? And I'll show you guys how you can use them to actually trade off of, and it really just sets your trade plan, and that's why I love these imbalances so much. But now, so that's just the concept of the fair value gap. We'll go to another chart and we'll look for some bearish fair value gaps as well, but this is just bullish fair value gaps. The same thing would apply. I think, yeah, you have one right here actually, so we might not have to go to another chart, but here's what a bearish fair value gap looks like. Ready? Let me zoom in and just make it a little better. Whoops. Okay, so again, we anticipate when price gets into our bearish fair value gap, price is going to reject lower, okay? Ready? So here's your low here, and there is your, see that? Your high. So I'm going to go over here and change the color to red, and that would be a bearish fair value gap, okay? So you'll notice that on either side of this down close candle, within this rectangle right here, there's no wicks on either side, right? So if there's no wicks on either side, that is an imbalance in price specifically to the downside, okay? So how can we view this, right? Well, look what happens when price gets back up into it, right? Wicks give you the heart attack. Did it take out the candle's high in this situation where it would be our all-out stop? Nope. But the wicks will give you the heart attack. The bodies of the candle are telling you the story. Look how perfect that is. And it creates your next leg down. Okay, so this was our first attempt, and you're going to notice, you'll say, hey, well, what happened here? We made a run through. Remember, it's just balancing price out, right? So again, on the first attempt into those, we have our whatever our expectation would be. So in a bearish fair value gap in this particular situation, we would expect a rejection here, okay? But when price takes off and moves up through the second time, right, what it's really the dead giveaway would be the creation of a bullish imbalance through a previous bearish imbalance, right? So there's your bullish imbalance right here. Boom. And right up and through, that's your second attempt, right? So that's just, again, how you can use it as a way to, pinpoint entries, pinpoint your take profit, pinpoint your stop loss. Everything is well defined when you use the concept of imbalances, okay? So let me just remove this for a second because it's no longer valid, obviously. We filled it up. Next time through, we made our way up and through. But as you can see, look how beautiful this is, right? You make your imbalance candle up, no wicks on either side. Price retraces back down into the imbalance, specifically 50% of it, and that's something we'll touch on at the end of this this video, and we take off again, right? Create another imbalance to the upside right here, actually. So I'll just annotate it, right? You see no wicks on either side of the candle, okay? That's all we have to worry about right now. So we'll continue down lower, okay? And now it's time to show you the second form of imbalance, and in this situation here, this is a bullish or bearish volume imbalance. And you guys probably all know this. It's really not that difficult to understand, but this is using the advanced gap theory, right? So we will use, I'm going to do another video on this as well, but gap theory, just think about it. If price is moving higher on a gap, right? To me, that's showing me urgency to move higher, right? So if we have an urgency to move higher, how should I view that specific gap or that specific level? I'm viewing it as bullish, right? If we're making a gap up, that's showing me urgency to move higher. If we gap lower, that's showing me urgency to move lower, right? So here's an example of a gap higher, right? And I want to dispel the theory, and that's why I'm going to make a separate video on gap theory, but gaps do not always have to get filled. It's the biggest misconception. People just like saying it, I think, to sound smart on Twitter, but they do not have to fill, all right? This one back all the way from March of 2023. Did we fill that? Nope. Look at any chart, any time frame, don't matter. You're going to see gaps all over the place, and they're not filled. They don't need to get filled. But by using this advanced gap theory, you'll notice, look at this. Price gets into our gap and we take off and we're gone, right? So with that being said, right, those are our two forms of imbalances. We have fair value gaps and we have volume imbalances, okay? Fair value gaps are with candles, volume imbalances are gaps higher, okay? Now, how can we trade off of this? How is this helpful to us, right? Well, like I said before, it's always defining what your entry, exit, take profit are every time, right? And what do I mean by that, right? So let's look at any one of these imbalances that formed. Okay, so this is a bullish imbalance right here, bullish volume imbalance specifically, okay? Let's say we use the high as our entry, 12,435, and we want our stop to be below right here, this low right here, because again, this is the candle that created that bullish volume imbalance higher. We want to use the low of that as our stop. Where would we look for our take profit, right? Well, we can always look for our take profit at the recent swing high or buy side liquidity. And in this situation, it was here at 13,091. So after price gets up here, right? I personally don't want to long this, okay? I want it to get into a discount bullish imbalance, and I have a video set for us to talk about the range, because while the imbalances are nice, matching them with the concept of a range is going to just elevate the success rate by a lot, okay? And I'll explain that in a second, but you'll notice, look, entry, were we red on this trade for a second? Yeah, we were, but guess what? We knew where our stop loss was going to be, so we're not bag holders, right? We know where we're going to take profits at our swing high, bingo, right? And you'll notice price does end up coming back down here even after breaking above it, so you would have another opportunity in this bullish imbalance as well, right? So everything is so well defined every time that we look to take a trade, right? Does it not come down sometimes? Yeah, sometimes it doesn't. And you know what? It stinks. You miss out on a trade, but guess what? There are so many stocks, ETFs, futures, anything that you want to trade, that just because you miss one, it's not the end of the world, right? I miss them all the time. It's not a big deal. Okay, but just quickly, I want to show you what imbalance would we use or would we want to use in order for us to make better decisions, okay? So you'll notice that in this specific price run right here, right, we are taking out this candle's high, okay? So I'm going to mark that candle's high just for show here. Okay, so the fact that we took out that candle's high with obviously a bullish move higher, what is that telling me? That's telling me that we have a bullish range or bullish market structure, okay? So when we form these imbalances, where are they going to act or be the most powerful? It's going to be in discount of a bullish range. So for example, what would be discount of the range? Okay, so let's take a look. Ready? Right here, bang. All right, so the price run that took out this high here was from that low to that high, okay? You'll notice that at 50% of our range is going to be our fair value or equilibrium of a price range, okay? So why would I not look to short that bearish imbalance right here, okay? The reason why I'm not looking to short this right here is because we're in a bullish price range, okay? We took out this high here with that price run. So if that's the case and we get that imbalance candle down, all that's showing me is that we're probably going to go down into discount, which we do here right at 50%. And from that point at 50%, we take off for our high again, right? So when we're in a bullish price range, I'm not really looking to short. I'm looking for price to retrace down into discount, and specifically a discount bullish imbalance right here, right, at 50%. So 50% and below, that would be our discount range. Now, you can get even more picky or particular if you want to, and only look for retracements down into the golden pocket or the 62 to 79% fib range, right? I don't trade off Fibonacci. I use it to map a range, but if it meets the criteria and I have on a retracement and I have a bullish imbalance down here in discount, that's when I look to actually take the trade. Okay, so from this instance here, right, price gets into this bearish imbalance, and while it does kind of stall out a little bit, you'll notice after we hit that discount, we make our next price run. So from this point, all I'm doing, and again, I know we're looking at the weekly time frame, but it don't matter. You can look at any time frame you want. And now look, okay, so the start of the price range to our high, right, of the price range, did we get a 50% retracement? Nope. So what is that telling me? Well, what that tells me is this would be a trade that I missed because we did hold this bullish imbalance perfectly, but guess what? I wanted to get into discount, and the fact that we didn't get into discount, oh well, it happens, right? So what is realistically, what is this telling me is the range is not set just yet. So if the range is not set just yet, I need to go find out where we're going to reset our range, and we're going to get our retest of 50% of the range. Aha, here it is. And this is just a situation where we can be right this whole entire time, but we want to be right when it hits 50%, because at that point, our risk reward is pretty dang good, and we kind of have a good idea of where price might want to end up, right? So that would be our range. Why? Because up until this point, you can go to every single high candle here, and we never retrace back to 50%, okay? But once we get to this high here, what was our indication that might be time for us to go a little lower? We form a bearish imbalance right there, the one that we looked at before. There it is. Bang. Price gets up into it, retraces lower. Even in this price run, okay, watch this. If we want to be really specific, okay, did we take out a low in this price run? Yeah, we did, right here, right? We took out that low with that price run, okay? Now watch this. Ready? Here's your high to your low, right? We took out sell side, we took out a low to shift short-term market structure bearish, okay? Why did we bounce here? Well, we had this bullish imbalance right here, so it makes sense, right? Again, every move can be justified with what we're looking at on the chart, okay? Price moves up into our bearish imbalance. Are we in discount of the range or over 50% in a bearish range? Absolutely, and there it is. What would our criteria be for our trade here? Entry off of the imbalance, okay, stop loss above the high that created the imbalance, and take profit at the lows. There it is. Bingo. Took it, okay? Again, you could do it again here. Ready? Watch this. Okay, high to low. Here's our retracement into discount above 50%. Here's a bearish imbalance right here. Whoops. Boom, boom. There she blows. Retracement in. Dump. Bang. Okay, and at that point, we finally get to 50% of our overarching or our higher time frame bullish range. And then from there, if you go back on Twitter, you'll see that was when I called that low. I like this low a lot. At Mando Trading, you can search that and it'll come up. But this is all it was, 50% retracement into a bullish imbalance. And we take off, and our target would be the highs. So in short, that's really the concept of imbalances. And I do think it's very important to have the ability to identify a range, because identifying a range shows you the more favorable bullish imbalances, bearish imbalances. But without that, without the range setting, bullish imbalances, which are in premium or over 50%, would be something like this, right? You can get a bounce here, but it's not one that I'm looking to long. I like when price gets down into discount, and the reason I like it is just based on what my risk reward would be ultimately for the trade to the upside, right? If we're buying it up here, and let's just, I forget what we had the range set specifically here, but if we were to come right here, you'll notice that, it was lower here. Yeah, because we never got to 50% on that retracement. Okay, so ready? If we were to long this, right? I don't have a set number here, but really maybe 25%. So we're really looking only at 25 points of the upside while the entirety of the range is 75% down. I don't like the risk reward there. It doesn't make sense to me. Okay. So, yeah, that's a lesson 1 just on imbalances, what they look like, with the meaning behind them and how we can use them to map out trades. So I'm going to put this out for everybody. If you have any questions in addition, please feel free. This link is going to be in the syllabus. You can go check it out there. But thanks for watching. This is lesson 1. I'll just tell you the other concepts that I want to look at over the next couple of weeks, and liquidity is one. I think that's the driving force of the market. You have market structure, which I kind of just showed you how we map the range. Breakers, order blocks, new week open gap / new day open gap. Our time signatures, because time is extremely important and something that I think is so underrated. And then we look at how we can formulate some sort of bias going into a week. So this is all I got. Thanks for watching, and we'll talk soon.